Hello everyone, welcome to The Plain Bagel. I'm your host, Richard Coffin. Welcome to the 10th ever TikTok React Plain Bagel video. Hard to believe we've done 10 of these, but with us getting the news out of the US that the country has actually cut a deal to keep TikTok in the country, sounds like we're going to be sticking around with this series. For better or for worse overall. For those new to the channel, welcome. My name is Richard Coffin. I'm a registered portfolio manager, a CFA charter holder, and a CFP professional. And today I'll be reacting to some finance TikTok, some hashtag not financial advice, to give some input, some feedback, and try to make things constructive, educational. And to celebrate this anniversary of sorts, we have a supersized episode for you today. So buckle up, we'll get through this together, and yeah, let's hop right into it.
If I had just $1,000 to invest in 2025, here's exactly how I'd break it down. This is coming from a dude that used to live in his parents' basement to now being worth 8 figures. The first $250 I would put into QQQ. It's made up of companies like Nvidia, Microsoft, and Google, making up the Mag 7. It has faster growth, higher volatility, and averaging around 18% annually. The next $250 I would put into VTI. It's a whole US stock market in one fund like Apple, Tesla, and Costco. It's super simple and you're just automating compounding without hype.
So just quickly on the ETFs, not inherently, high risk investments, but I will highlight that especially when it comes to QQQ, these aren't as diversified of funds as they used to be. I think Nvidia, for example, is like 10% of QQQ now. And between these two funds, there's also a lot of overlap. I think roughly half of the positions by weight are effectively the same. So you aren't actually really diversifying that much by buying these two different funds. Again, not inherently bad investments, but you are making a very active bet on US tech-heavy, large market cap companies. So something to be aware of.
Then I would put $250 into STRF. It pays consistent 10% dividends with downside protection. You can reinvest those dividends automatically for steady income. And finally, the remaining I would put into Bitcoin. It's digital gold, it's scarce, it's global, it's decentralized, and institutions are recognizing its unmatched potential. This is the highest conviction, biggest upside, and strongest asymmetric bet. You can lock it away, dollar cost average, and let scarcity drive returns. Make sure you save this video and come back to it in a few years to see if I was right.
Okay, I do have some issues with the Strife suggestion. So for those unaware, Strife is a preferred share sold by Strategy, which is the Bitcoin treasury company that's raising a bunch of investor money to just buy Bitcoin. So they're effectively a leveraged Bitcoin proxy. And the issue is that these preferred shares and the convertible notes that they're selling, they promise an interest rate, in this case, a 10% yield. There's no cash flow to pay those dividends. They're raising money, buying Bitcoin, and then to pay those dividends that they're promising people, they're either selling their Bitcoin or raising more money from other investors to pay off the earlier investors, which some people made the comparison to a Ponzi scheme. Yes, it could do fine if Bitcoin continues to appreciate in value, but that's a lot of risk. I have no idea where that downside protection comment comes from. In fact, with preferred shares, shareholders take on a lot of risk because while this instrument acts like a bond in that it promises a fixed payment, A, there's no face value or maturity, or in this case, no conversion right. So there's no date at which that lent amount is going to be paid back. And B, because it's technically not debt, it's classified as equity, there's no legal obligation to pay these dividends. Strategy, if they have a hard time, they can just stop paying these dividends to Strife shareholders, which will severely impact the value of the instruments they hold. So I would definitely not categorize this as a safe investment. Also, in terms of consistent, they've paid 2 dividends so far. So I don't know where that term's coming from. Maybe he means consistent as in the payment is fixed, like they've promised 10% every payment. But yeah, it's definitely a lot of risks with this type of investment, as you should expect with something that's paying a 10% yield. That's not typically sustainable.
I'm gonna show you how to make your first 10K as a trader trading option. And no, you don't need like tens of thousands of dollars to start doing this. You could literally do this with a couple $100 to $1,000.
Even better, just upping the ante with that.
What you wanna do is go on a charting platform. I like to use tradingview.com. I think that one's the best. Then you're going to head over to the indicators tab, and then you're going to search up the 3 EMAs by this author right here. Then you'll just add the 8, 21, and 50 EMAs.
So quickly, EMA stands for exponential moving average. It's just an average of the last however many days. So you can have a 100-day EMA, for example. The average is a price over that period of time. It's called moving because every new day, obviously the period is 1 day forward, both in terms of the first and the last date of that period. And then exponential just means that it puts more weight on the more recent data points than the older data points. So just a quick explanation. The chart is basically just an average of sorts of the prices we're seeing.
This is going to be the 8, 21, and 50 EMAs. So whenever stocks are above the moving averages like so, we we are clearly in an uptrend and we're probably going to continue up. So this is when you want to be looking to buy calls. Whenever the markets are below the moving averages like so, you're clearly in a downtrend and you're likely to continue to see new lows. So you can either stay out of the market or you could buy puts and trade things to the downside. So what I'm looking for is a level that price has rejected multiple times, basically a resistance level. So right here, you can see the stock rejected, 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 and rejected. So we know that if it gets above, it's probably going to make a big move up, and you can target some of these highs for a continuation move.
So for time, I'm going to stop it there. He does keep going. He explains that later in the video. You also want volume, meaning that there's a lot of trading activity to kind of confirm the trends you're analyzing. And the appeal of these types of systems and the like is that they seem very simple and they give you a very clear yes or no, right? What's funny is that in this video, you can see examples of where this strategy would have gone horribly wrong. Like you have here, for example, where the price is clearly above the moving average lines, and yet the stock plummets thereafter, meaning that you would lose a bunch of money if you had bought here. You'd basically be buying at the top if you're day trading. And then here you have the exact opposite, where the price is below these moving averages and then it surges right after. So you have to be careful with these types of videos, right? Because anyone can take any trading pattern and make it look attractive in post, right? When you have the ability to go look historically for a segment of time that fits your narrative or fits your trading pattern. In terms of making $10,000 from a few hundred or a few $1,000s with options, yes, they do introduce leverage, which means that they sort of amplify the returns you can experience from a standard stock by using options for that same company. But you have to keep in mind that leverage also expands your downside, right? The chance of going to zero is much, much, much higher with call options and put options than it is with buying the actual underlying stock. And if you're betting everything to try and see this massive surge in return, it's very easy to very quickly lose everything. Now, if you're someone who's interested in day trading and trying to see those massive upswings in value, have no fear. I won't leave you empty-handed. I'll share a proprietary plain bagel trading strategy that's just as likely to take you from a few $100s to tens of thousands. So basically what we're gonna do here is we're gonna take all of our money and always put it all on black. We can ignore all the numbers here. Just focusing on the color strategy, picking the one. Next TikTok.
A quick note that Richard is not actually gambling real money here and does not seriously endorse gambling. We hope that's obvious, but because Richard doesn't trust any of you, he felt the need to clarify. Anyway, sorry for interrupting. Back to the video.
Today I decided I'm going to be cashing out my entire retirement. I recently discovered, which I should have researched earlier, that my retirement is doing really well because 16% of my mutual funds are invested in BlackRock, and it doesn't sit well with me. Today I'll be calling my financial advisor, and I'm interested to know if anyone else has personally divested. How can I expect organizations to divest if I myself have mutual funds that are doing well because of BlackRock, which is known to be harming communities? So yeah, I just felt called to share that. And if you're in my family and you're seeing this, it's gonna be fine.
I gotta be careful with this because I don't want to be labeled a BlackRock sympathizing globalist co-conspirator. But for the 1,000th time, it's not BlackRock that's buying single family properties in the United States, which is what I'm guessing she's talking about when she says harming communities. Maybe there's something else that I'm ignorant to, but their primary business is setting up funds that invest in publicly traded stocks. There are companies out there that are buying single family homes, for example, Blackstone, which is where a lot of people make that mistake because the names are very similar, but they overall represent a small fraction of buying activity. So you can still criticize the practice. I'm not here to defend that, but BlackRock's the wrong company. They do buy multi-tenant properties like apartment buildings and purpose-built communities, but not individual houses. In terms of pulling her money out, I don't know if she means she's 16% invested in BlackRock funds or BlackRock specifically, like the actual company since they're publicly traded stock. And I'm Canadian, so the rules are slightly different here, but I am aware that with the 401k, while their options can be limited, there are typically other funds you can look into. So certainly a route worth exploring before pulling money out. And if you do withdraw that amount before a certain age, I think it's around 60 in the United States, there's actually a 10% penalty on whatever you withdraw, in addition to income taxes. There are some exceptions where you can avoid that penalty, such as in periods of financial hardship. There are also conditions where you can roll a 401k into a different type of account without a tax consequence. So lots of other stuff to look into. But generally speaking, the benefit of the 401k is tax deferral, meaning that's best to leave the money in the account, let it grow tax deferred until you reach retirement, when you can pull it out at a lower income tax bracket than you would be if you pulled it out earlier, say in your 30s. So at least she's going to talk to her advisor. Hopefully they can share that information, but just some stuff to be aware of.
So how long will it take me to replace my income via the stock market? I had this crazy idea while on maternity leave to take 1 week of my leave benefit, invest it in the stock market, and use that to sell covered calls to try to replace my income. I just jumped in without doing any math. But now that we're a month in, I've had some time to crunch the numbers and see how long it's going to take to actually generate enough money in premiums to replace my income. So the amount that I started with was $1,542, which is the maximum benefit in the state of Washington for paid family leave. So far, I've been able to earn about a 10% return on that initial capital, but it's unrealistic to think that that amount would continue consistently week after week.
Okay, so she made, what was it, $150 roughly? So, I mean, we're a bit off, but she's grounding her expectations. So I'm going to give her a chance. That's good. I'm glad that we're seeing that.
So I looked at a couple scenarios with different amounts of returns each week, and the fastest
weekly.
that I could.
She's talking about weekly returns. Oh no. 10%. Okay, guys, unrealistic. Come on, we can't earn 10% a week. 8%. Now we're talking. Oh, I had such high hopes for this one.
Potentially replace my income would be 31 weeks. And a middle amount would be about a year.
5% middle. Jesus. Annualized 5% a week is still like over 1,000% a year. Okay. I'm sorry, you can't retire off $1,500. I'm sorry to be the bearer of bad news. I know we were hoping for something different, but like these are crazy figures. I know it's covered calls, guys, but I'm crashing out on the fourth video. I don't know if this extended video was a good idea.
Basically, what I need to do is grow that $1,500 that I started with to somewhere between $20,000 and $30,000 in order to have enough capital to invest to earn about $1,500 a week selling covered calls. So while this is definitely a slow process, it will generate income much faster than just investing in dividend stocks or just investing in the overall stock market in general.
Man, there is a lot of hype and excitement around covered call type strategies, which for the uninitiated, a covered call is when you own a stock and then you sell call options for that stock, meaning that you sell the right to someone else so that they can buy your stock at a predetermined price if it increases in value. And people like it because it feels like it's generating free money. You have a stock, and while you own that stock, you're selling this contract, this right to buy it. And so long as the stock price doesn't increase in value, you get to keep that premium that you're earning, right? Sounds like a great deal. People don't understand the risk return trade-off you're accepting for that contract. What you're doing is you're cutting off your upside because the stock surges in value. You have to sell it to someone for less than that value, right? You cap your upside and you only slightly compensate your downside with this premium whenever you do this trade. The idea of taking $1,500 to tens of thousands of dollars should be a red flag to anyone. It doesn't matter what the trading strategy is, right? You have to realize that whenever you're taking a strategy, someone's taking the other side of that arrangement and they're possibly doing more math than you are, right? In fact, there's a video posted by Ben Felix not that long ago that showed for broad-based ETFs that are covered calls, they over the long term have underperformed their non-covered call equivalents when put side by side. And the problem is that people look at the yield and they're like, wow, look at how much money I'm earning as income, without recognizing how much they might be losing on the price side. In fact, we've seen funds get in trouble for just highlighting the yield while ignoring the fact that their ETF is falling in price. Covered calls, a little controversial. Some people love them. Most people misunderstand how they work. And you should not buy these types of products if you don't understand how they work. So I'll leave some resources. You can click in the link in the description, if you want to check those out. But anyway, next TikTok.
You are crazy if you think that the way you are going to get rich is from making the money that you have right now and just investing it in the stock market. That's insane. Why? Because what you are actually doing is you're just letting other people get rich. Who gets really rich? The asset managers who manage your money, the banks that hold your capital. Why do they get rich instead of you? Because what do? They take your money and they do something with it proactively. So they take your money and they take real risk with it. And I think unless you take risk with your money, but also with yourself, you're never going to get wealthy. And so you and I could go very viral on the internet every single day if we talked about how to invest your first $10,000 to get to $100,000.
Yeah.
You could get a lot of views on that, except it's totally pointless. And if what we really want to do is elevate people to real wealth, where they have enough money for all the things that they want in life, it's not done through investing. It is done through earning. That is the only way you make real money. Once you make real money, you can make more of it through investing. But in the beginning, you got to earn. That's it.
Some misconceptions here. One, when it comes to asset managers, it's kind of the opposite. They don't actually take that much risk. There are funds where there will be like co-investment and the like. But when you invest through BlackRock or these funds, they make their money by charging a fee for facilitating that investment, but they don't inherently have any of their own money at risk. It's actually something I find kind of frustrating with the whole Bitcoin conversation when people will say, look, the institutions are coming. BlackRock must believe in Bitcoin because look at how much Bitcoin they're buying for their funds. It's like, they don't really care. They want more investors to buy it because then they'll have a larger base to charge that fee against, but they don't really lose anything if that investment crashes or loses value. So they're a bit agnostic. They just want people to buy their different funds and be the one to offer all the types of funds so that they have the biggest net to catch investors in. Secondly, when it comes to the earnings versus investing, I can kind of agree with that in that most people should focus more of their efforts on increasing their earnings, improving their skills and things like that versus trying to improve their investment returns, spending more time trading in the like, because there's much more marginal benefit over here. But investing very clearly helps, right? If you put away $500 a month for 40 years, even if you earn just a 6% return, you'll end up with nearly $1 million despite having only saved about a quarter of that amount through your earned money, right? So investing over a long period of time can still carry the majority of your net worth by retirement. I can agree that you shouldn't expect investing to make up for a lack of earnings or things like that, especially because that's when you get really dangerous with things like chasing returns and these day trading kind of high risk strategies. But yeah, just some things to clear up there in terms of the overall message.
When I sat down for the first time to learn how to trade, the first thing that my uncle said was, everything I'm getting ready to teach you is all you need to know. And he told me that the ones that knew the least amount about trading, that knew nothing prior, were the most successful when it came to trading.
How convenient. How convenient that the people who have no prior experience, who might be starting from scratch, are going to be the most successful. It'd be a shame if you were just selling a course to beginners to try and, oh, there it is. Yeah, okay. We have Trader in 30 Days challenge. Easy. And you know what? You'll be the most successful if you don't know what you're doing.
People that already have previous knowledge, they develop biases when it comes to trading. They look for other things to incorporate. They have old habits. He said the ones that started fresh and took everything he said for face value were the most successful. So when he told that to me, I did exactly that. Everything he taught me is exactly what I've been using for the past 9 years. That's wild. To stick to something and believe it fully for 9 years, you don't get to see any of the benefits of it the first few years because you've still got to master psychology. You still got to master the strategy itself and the instruments that you're trading. But then to see the benefits that you reap, it's incredible. And I hope that you guys can understand that and try to experience the same thing for yourself. So don't forget to hit that follow button for more trading tips.
You know what? I actually couldn't agree more. Sometimes the best returns come from sticking to the strategies that are simple, that you know the best. Damn it. What I find frustrating about people who promote day trading courses is, one, it's all pseudoscience. Like, these people are just trademarking random patterns and indicators and then using cherry-picked stock prices and past performance to prove that they work. But also, like, that focus on psychology, it's on the one hand, it's marketed as something that's so simple, anyone can do it. If you don't know anything beforehand, this is still a winning ticket to beat the markets. But also, it's such a handy out when people don't do well. Like, investor psychology is a thing that we have evidence of impacting long-term performance. But when you're selling some sort of easy to follow formula for making money, you can't also play the card that emotions will somehow dictate your outcome. It's become a habit that the first thing I do whenever I see a TikTok now is check the person's profile to see if they sell a course or some sort of service, because it helps frame everything nicely. And I'd recommend that for anyone who's looking at TikTok for advice and the like, is, look at the person's incentives, see what motivates them to tell you the messaging that they're sharing in the video. Because as Charlie Munger once famously put it, show me the incentives and I'll show you the outcome.
You are an idiot if you're not watching these 3 stocks for Thursday's trading day. Finally, IPOs are back on fire, with this new IPO today exploding over 60% into the close. And it looks like it's ready to squeeze much, much higher.
It's funny, there used to be 5 best stocks to buy in 2025 or this year. Then it was 5 best stocks to buy in this month. Now we're talking weekdays. 3 best stocks to buy Thursday, October 2025.
First up on the list is the stock that exploded over 100% today in after hours on CIGL. This is an explosive looking continuation style setup, but it has to get broken out over this level first. What I want to see here on CIGL tomorrow is a strong break over this 540 level over the previous high of day. If we see that past high get breaking in a strong way, I then want to see price pull back and retest somewhere over $5 a share and put in place a bottom. If we see price put in place a bottom over $5 after getting breaking out, we have range to the upside here all the way to $7.50 to the upside, giving us tremendous amount of range. But as always, no break, no trade. Number 2 looks even better, and it's the massive explosion today on quantum news on RVSN. Now this thing looks so...
Okay, look, I get the boxes. I get we're drawing off of tops and bottoms of candles, whatever. What are these price projections? Why are we doubling our money randomly? Is it just because the stock did really well the previous day? Is that why we're forecasting like this? Is this what every weekday video is forecasting? Like that's crazy. Yeah. Okay. So none of the stocks got even close to what he was projecting, but hey, it's one hell of an arrow he drew on there. I was half convinced just by the audacity. You have to be careful about these type of micro cap or even nano cap stocks. Even sometimes these videos and these types of traders can influence the stock price of this very low volume trading stock with these types of videos. So I'm not accusing this guy of doing anything. I don't know who this guy is, but when you talk about these areas, you can move the price with this type of influence if you have enough of a following and if you have Discord groups and the like. So you have to be careful because at times you could very well be the exit strategy for some of these traders, right?
No, America is $1 trillion in debt, but I know how we could solve this. Let me take the debt, bro. Someone has to do it. Someone has to step up and be a freaking $1 trillion in debt. And I'm not afraid to be that guy.
Oh, man. Taking one for the team.
You know what I'm saying? Who's it even in debt to? Who's the one that's going to pay this debt? This debt doesn't even really exist. Let me be the one to have this debt, bro, because then I could say I'm $1 trillion in debt. I'm a trillionaire. You know what I'm saying? That would make me a real trillionaire.
I mean, according to some influencers, yeah. You should buy some properties while you're at it. On a serious note, funny TikTok, on a serious note, that question does actually circulate a lot. People wonder, like, who the hell is all this money to? The answer is actually most of the U.S. government's debt is to U.S. citizens. Because, yes, we talk about the U.S. being in debt, but again, there's different parties, right? There's the government, there's private corporations, private investors. And the U.S. government sells a lot of its bonds, its debt to individuals and institutions. There is about a fifth that's held intergovernment. So there is this weird dynamic where you do actually have different departments of government owning its own debt. On top of that, most of U.S. government debt is held domestically, which makes it consequential if the government were to ever default on those payments, right? Because that means lost money for American citizens and American companies, right? It sounds great to just wipe out a debt and start from scratch, but huge consequences domestically. And then in terms of that other third or quarter of the debt outstanding, there are other countries like China and Japan are big holders. I believe they have nearly $1 trillion each or around $1 trillion each of US debt. And yeah, sadly, a lot of consequences to having this guy take it all on, but I like that one. That was a good palate cleanser for all the other ones.
Don't ever pay a debt that's been sent to a collection agency. Instead, let me show you how to make that shit completely disappear, or at very least make it a hell of a lot cheaper. But Devin, I don't want it to negatively affect my credit. Fun fact, if it's already in collections, the damage is done. Your credit is already fucked, so you might as well thug it out and try to save yourself some money. First things first, you need to understand how debt collectors actually work. Let's say you owe Chase Bank $2,000, but you don't pay it for 6 months. They're gonna take your debt and they're gonna sell it to a collection agency for $1,000. That agency is gonna contact you, try to get you to pay the $2,000. If you don't, they're gonna offer you to settle your debt for $1,500. You don't do that, that, they're going to take your debt again, sell it to another collection agency for even cheaper, so on and so forth. The cycle continues. So the longer you hold out, the cheaper it's going to get. And get every agreement in writing. It does not matter what they agree upon over the phone. These people are fucking scumbags. Second, as soon as this collection agency buys your debt, it is no longer yours. It is their debt now. You did not sign any agreement saying that you would be legally obligated to pay this collection agency any fucking money at all, until you verify who you are. You ever been called by a collection agency a million fucking times and all they try to do is get you to say your name? They won't tell you who they are, where they're from, why they're calling you. The reason for that is because as soon as you say your full name and assume that that debt is actually yours, you've now just given them a verbal signature or a verbal agreement that you're gonna pay them that debt. Not to mention that some debts have a statute of limitations, meaning that after a certain amount of time, they can't come after you in court and force you to pay that debt or sue you if you don't pay it. But in some situations, when you say your name and assume that debt, that timer resets to 0. But let's say you already told them your name, you messed up, you already assumed the debt. What you're gonna do now is request a debt validation. A debt validation is a list of documents that they have to legally provide and have on file that have all your legal information correct, all your debt history correct, and all documents preceding your debt history. And if they're missing or have any of that information incorrect, I'm talking having your birthday off by 1 day, you're gonna dispute it and they're gonna have to send you a letter saying that this debt is now invalid. Then you're gonna take that letter, send it to the credit bureau, and they're gonna remove it and make it like it never even existed to begin with. You're welcome, and you better fucking follow me.
Okay. I'll be honest. I don't know if that verifying identity thing is real or not, whether that resets your statute of limitations timer or whatever. But to be clear, even if a debt collector has paid for your debt, which is a real thing that happens, that doesn't mean you are now legally not obligated to pay that person. You still are in debt to that entity, right? Doesn't matter that it's changed hands. And a debt collector can still take you to court or petition for you to be declared bankrupt if this happens. I don't think that would happen with a small fee like $2,000, given that the legal fees and the like would likely not make it worth it. But you still have that exposure, that liability in your name. And I wouldn't bank on a typo to get you out of it. And if courts do intervene, they have tools like garnishing your wages, for example. So any money you earned gets directly transferred, some portion of it, to your creditor. So you can't just ignore your debts and assume that, it'll be forgiven if you thug it out, as stated here. Especially because the whole time that this is outstanding, that means you can't get a mortgage on a new home, you can't get credit card debt, and as long as this is outstanding, you haven't started healing your credit score so that you can then use debt in the future. So even if you aren't taken to court, even if this does eventually get forgiven, that's a big cost you've taken and a long period of time that you've gone restricting yourself from that sort of financial access. Whenever you're in a situation like this, don't take TikTok advice because it might have unintended consequences that aren't covered in this video. Definitely reach out to a professional. In the US, there are certified credit counselors. In Canada, we have licensed insolvency trustees. They can advise you on your options, including things like declaring bankruptcy, which have a lot of personal protections in place, or a consumer proposal where you negotiate for a better payment plan. But importantly, when you take these types of actions of, refusing to take phone calls or refusing to negotiate, that actually reduces your likelihood of getting a favorable ruling or treatment by the courts. So don't take advice from TikTok. A lot of risk of unintended consequences with these approaches. Definitely speak to a professional if you find yourself in this type of situation.
Is day trading gambling? Overall, the answer is yes.
A lot of day trading ones today. I don't know why. That's just what was found.
But the best way I could describe it is gambling, but the odds are in your favor. When you enter a trade, it either goes up or down, 50-50, which is basically a coin flip. But hypothetically, if you could guess that coin flip and make $1,000, and you watched that person flip the coin for 3 years straight, where they placed it on their thumb, how hard they were flipping it, what it looked like in the air, do you think after 3 years of watching every single thing happen and journaling all of it, do you think you could guess it more than 50-50? If you do think you could, that's what trading is right there.
On big money. Big money. Damn. Absolutely devastating. Well, everyone, that was the 10th Investment Analyst Reacts to Investing TikToks. I hope you found it helpful. Hope we learned a little bit of something. If you liked it, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. Let me know your thoughts on your favorite TikTok, your favorite tips and wisdom that we garnered here today, and any other content you'd like me to react to. If there's a movie or a piece of media that you'd like to have my input on, then let me know down below and I'll do my best to get to the popular ideas. But thank you again for joining me once again. And as always, be safe out there.